China just sold $688 billion worth of U.S. Treasury debt at a loss. That alone should get your attention, because this wasn't a routine market move, and it wasn't about timing returns. It happened while bond prices were already down, meaning the losses were intentional. When the second largest holder of your government's debt is willing to lose money just to exit, something deeper is changing. This isn't about markets reacting, it's about strategy and what comes next. Military movements are designed to be seen. They're flexible, reversible, and often symbolic. Debt isn't. Sovereign debt is slow, heavy, and deeply embedded in the global system. You can't unload hundreds of billions of dollars without planning, and you don't do it accidentally. That's why the U.S. Treasury's own data matters. The Treasury International Capital report shows China's official U.S. Treasury holdings have fallen to $688 billion, the lowest level since 2009. At its peak in 2013, China held $1.32 trillion. Nearly half of that position is gone. This isn't routine portfolio management, it's a structural withdrawal. The most important detail isn't how much China sold, it's when. Throughout 2024 and 2025, U.S. bond prices were depressed. Selling during this period meant locking in losses. In asset management, you don't do that unless the asset itself has become dangerous. China isn't facing a liquidity crisis. Despite domestic challenges, it continues to generate large trade surpluses, which leaves one explanation that fits the data. Beijing no longer trusts U.S. treasuries as a store of value. That realization traces back to February 2022. When Russia invaded Ukraine, roughly $300 billion of Russian central bank reserves were frozen by Western governments. These were official state assets, and they were immobilized overnight. China watched closely. The message was unmistakable. Reserves held inside Western systems are conditional. If geopolitical lines are crossed, they can be frozen, seized, or rendered useless. For China, that changed the risk calculus entirely. U.S. treasuries stopped looking like neutral savings and started looking like hostages. Normally, an exit this large would crash prices and send yields soaring. That hasn't fully happened, which tells us someone else stepped in. The TIC data shows who. UK Treasury holdings surged to over $750 billion, rivaling China. Belgium's holdings also spiked sharply. This isn't organic demand. The UK doesn't generate surplus dollars like China once did. Belgium isn't suddenly wealthy. Belgium is home to Euroclear, a custodial hub often used by other governments and institutions. These flows strongly suggest U.S. allies are absorbing China's exit to keep the market functioning. China could buy endlessly because it earned real dollars by selling real goods. The UK and Europe don't have that capacity. They rely on leverage, financial engineering, and borrowing. That makes this arrangement fragile. If domestic pressure rises, inflation, currency weakness, pension stress, these allies may be forced to sell the same bonds they're buying today. Political buyers are not permanent buyers. China understands this. Its strategy isn't panic, it's attrition. When China sells treasuries, it receives dollars. But it doesn't want dollars. Dollars are traceable, sanctionable, and inflation-prone. So China is converting paper claims into physical control. Gold, which carries no counterparty risk. Oil, filling strategic reserves to reduce vulnerability to blockades. Copper and industrial metals, essential for energy grids, manufacturing, and defense. Food, building reserves to withstand supply disruptions. These assets don't generate yield. They cost money to store. But they can't be frozen. This isn't about profit, it's about survival. A nation preparing for peace optimizes returns. A nation preparing for disruption optimizes resilience. For decades, U.S. treasuries anchored global portfolios. When stocks fell, bonds protected capital. That assumption depended on one thing: endless demand. China's exit exposes a new reality. The treasury market is no longer purely economic. It's political. Stability now depends on coordination,
pressure, and central bank backstops. When political buyers reach their limit, only one buyer remains: the Federal Reserve. And when central banks become buyers of last resort, risk isn't eliminated. It's transferred into inflation and currency erosion. China is leaving before that phase becomes unavoidable. The $688 billion figure isn't important because of its size. It's important because it marks a break in belief. For nearly 2 decades, China was a pillar of the Treasury market. Its withdrawal tells every other participant that U.S. debt is no longer neutral. Once that belief fades, demand becomes conditional. Liquidity thins. Volatility rises. Intervention becomes normal. The system doesn't collapse loudly. It erodes quietly. This isn't a market event.
It's a geopolitical divorce. China is deliberately removing itself from U.S. financial leverage, even at a loss, to ensure survival under pressure. Allies are absorbing the shock with borrowed capacity, and the bond market is becoming a battlefield rather than a safe haven. The current stability is artificial. It's held together by politics and pressure, not trust. The $688 billion exit is a countdown clock, not to collapse, but to transition. The old system still functions, but belief in it is fading. And once belief goes, the system never works the same way again.